Hey everyone, this is a presentation on an overview of the asset management industry. I'm Mark Potter from Babson College. So one of the things that we have to talk about is the financial management or investment management industry as a whole. You can divide it up a couple different ways, and one of them is understanding the difference between the buy side and the sell side. So in short, the sell side is focused primarily on placing or selling securities, and the buy side is focused on purchasing securities or investments. So sell side firms include companies related to investment banking and commercial banking. They include companies that trade securities and recommend to others which stocks to buy and sell and which bonds to buy and sell. Another key difference is that the sell side companies focus on helping firms raise money by selling those securities to other people. So, for example, you would have a company like Bank of America help Dell EMC raise either debt or equity capital and sell that debt or equity capital on the open market. On the flip side, you'll have buy-side firms that promote things like mutual funds. So we can see this sheet gives us an indication for the largest investment banks, at least as of the beginning of 2018. And this is just 20 of the largest firms. These are called bulge bracket banks, and you have also niche investment banks that focus on a particular industry or size of company that they try to help. But essentially, investment banks are code for sell side. Here's a list of the world's largest money managers. And so you can see that there are some overlaps between the list on the previous slide and this one. So for example, JP Morgan is a sell side company, but they also have a department or division that focuses on the buy side. Same thing with Goldman Sachs. Goldman Sachs is a sell side firm, but they also help people manage money. On the flip side, you have some key buy side firms in here. And again, these are companies that have essentially mutual funds and exchange traded funds that allow you and I and other institutional and corporate purchasers to invest our money. So BlackRock, Vanguard, for example, Fidelity, PIMCO, Wellington, these are buy-side companies. They essentially get paid to manage our money and help it grow. And that's essentially the difference between the buy side and the sell side. In terms of, if we go to the buy side and we think about mutual fund firms, who are their customers? We have people like ourselves, and so we have individuals who, I pay my mortgage, and I pay for my car, and I pay for my kids' food, and then I have some money left over. And what I do with that is I take it and I invest it in mutual funds to save for things like college and retirement and so on. And I would probably be considered, it says mass affluent here, but essentially it means folks who are able to invest beyond have enough disposable income to invest beyond what their day-to-day needs are. And you can see that this group has grown significantly in the last 10 to 15 years. So this is sort of a proportion of who manages or who invests in these mutual funds. So we've got pension funds, insurance companies, we have governments that have cash that they want to invest That's called sovereign wealth funds. We have high net worth individuals. These are folks that have maybe top 1 to 3% of um, uh, wealth in different countries. And then we have the everybody else, the mass affluent. And so we can see that from 2004 to 2015, this is not quite doubled in size, but grown significantly. And if we look at which categories have grown the most, that if this overall has almost doubled, the categories that have grown the most include high net worth individuals have grown from 38 to 68 trillion, and also pension funds and the quote unquote everybody else category. And in terms of expectations, this is a PwC PricewaterhouseCoopers study that what do we get to manage? Just because they have the money doesn't mean that we get to manage it. And so at this bottom row has penetration rate. So for example, in 2004, buy-side firms and mutual funds manage roughly 31% of customers' wealth. And in 2015, this grew to about 39% of customers' wealth. This is probably going to stay the same for at least a little while. So what have we got? We've got buy-side firms, which manage people's money. And who are the people's money? Pension funds, insurance companies, governments, high net worth individuals, and quote unquote everybody else. In terms of assets under management, that's AUM, in the past couple years, this has grown to about 70 trillion. You can see the difference between 15 years ago, 10 years ago, and the past couple of years, that the assets under management have grown significantly. But a lot of this has to do with the fact that values have grown. In other words, the value of a stock or of a bond has gotten larger, as opposed to people and companies giving us more of their wealth to manage. So, for example, let's say last year I had $200,000 invested in the stock market. And then the stock market went up by 10%. So I have 220,000 invested in the stock market. I didn't give TIAA, CREF, or Fidelity more money of mine to manage. The value of those stocks have gone up. So that's assets under management versus if I gave them an extra percentage of my pay each week or each month. So how these buy-side firms get paid has to do with both assets under management as well as whether or not I provided additional cash to them each month. So we can see that assets under management has grown, but the flows going into each of these funds has remained relatively flat over the past, call it 5 or 6 years. So this means that buy-side and money management firms are fighting for smaller and smaller proportions of additional money coming in. We can see that assets under management continues to grow around the world, and as a percentage, overall grew at 7%, but it's very different from one region to the next. So Asia tended to have faster growth. Latin America tended to have faster growth. And North America, Europe, Middle East, Africa, Japan, and Australia tended to have smaller than average growth. So when companies and buy side firms manage other people's money, they get revenue from that. In other words, mutual fund firms charge me each year for managing my money. And they also have costs. So even though assets under management have grown, revenues have not. Costs remain flat. So the profitability, and this is a Boston Consulting Group analysis of the investment management or wealth management industry, is that even though assets under management have grown 7% to about $70 trillion, that the industry itself has not become more profitable. And the reason for that is something that we're going to talk about in a couple of minutes. So when companies manage money, they can choose different products to offer. So for example, these buy-side firms and mutual funds will offer me different choices. I can invest in stocks, bonds, a mix of the two. I can invest in alternative assets like hedge funds, private equity, real estate, currencies. Also, I can pay these companies for me to manage these investments active or passive. In other words, I can buy mutual funds that are managed by a person or group of people that every day look for investments that are undervalued to buy and overvalued to sell. Or I can invest in mutual funds that are passive. In other words, they just seek to match the average performance. And in this case, it's managed sort of by a computer that I just want to invest in the Standard & Poor's 500 stocks in the relative weights that are maintained. So big companies, I invest more of my money in them. Small companies, I invest less of my money in them. And this very busy chart or graph illustrates the change in time over time of what people are invested in. So, for example, on the left-hand side, we have assets under management. In other words, where is the money invested? And on the right-hand side, we have revenues. So which product promotes or supports the most revenue for these buy-side or money management companies? And so let's just focus on the right-hand side for a moment. You can see that the blue area is the largest and has grown significantly from 2003 to 2016 and is expected to continue to grow. What area is that? That's alternative investments. And on the next slide, I'll go through some examples of alternative investments. The green is large, but has stayed relatively constant over the past 15 years. And those are active investments. The yellow is small, but has grown significantly in the last 15 years. And those are called those are solutions. In other words, those are investments that have a specific goal in mind. So for example, a target date fund. I invest in target date funds for my kids' college. So I put money into this target date fund, and it might be target date 2025. And the managers of those mutual funds will manage that money knowing that I will need it in 2025 to pay for my kids' college. So they'll take different risks than a target date fund 2035. We can also see this light green has shrunk and is becoming a smaller proportion of our revenue stream over the last 15 years. And those are actively managed core assets or core securities. And those, again, we'll talk about those on the next slide, but those are essentially actively managed funds that are managed by individuals and teams to buy undervalued and sell overvalued securities. And finally, we have passive funds, and those are things like ETFs and index funds that were small but are growing. And I want you to focus on the difference between assets under management and revenues. So assets under management, passive funds are growing significantly, but do not make a lot of money for us. Those are low cost to investors. So this chart, another busy chart from the Boston Consulting Group, we have on the vertical axis compound annual growth rates. So which of these types of investments is growing at the fastest rate? So if we focus on just the vertical axis for a minute, we see the fastest growing things that people are investing in are exchange traded funds, both equity exchange traded funds and fixed income exchange traded funds. Also growing quickly are quote unquote solutions. And solutions include these target date and global asset allocation funds. So if I'm saving for retirement and I have 20 years left till I retire, I will tell somebody that I want to put my money into a target date 2040 fund. And a 2040 fund will be managed by somebody so that it takes higher risks when I have a long ways to go till retirement and less risks as I'm approaching retirement and I'm going to need the money. So the things that are highest growth are ETFs and these solutions. Also, infrastructure funds, private debt funds, private equity are also growing at a more quick rate. The things that are not growing are the things toward the bottom of this, which are money market funds, bond funds, fixed income funds. These are things that people invest in. Notice how large they are. These are large circles, but they're not growing very quickly. On the horizontal axis, we have the most profitable. Which ones are the most profitable? So money market funds are the least profitable. Private equity and hedge funds are the most profitable. So private equity has both high growth and profitability. Hedge funds, or investments in multiple hedge funds, is low growth but high profitability. So in terms of both assets under management as well as revenue stream and growth, you can start to get a picture of the investment management and money management industry and how different products are offered to different customer groups. Remember who our customers are. Our customers are pension plans, insurance companies, high net worth individuals, and everybody else. That constitutes the majority of our customers. And what they are electing to put their money into is the stuff on this page. And we have things that are high growth, low growth, high profitability, and low profitability. If we disentangle this and unpack this a little bit more by region, these are all specific products that are offered to our customers in the United States, Europe, and in the Asia Pacific region. If we focus just on the United States for a couple of minutes, we can see that, like we saw on the previous page, money market is has the largest assets under management. Money market is like cash, okay? It's our day-to-day cash balance, but we want it to earn a little bit of money. We don't want it just sitting in a vault somewhere earning nothing. So we give it to buy-side firms and mutual funds to manage, and it might earn 0.5%, 1%, 1.5%. Not a lot, but it's low risk. And even though it's not a lot, it's better than zero. And then a distant second would be stock mutual funds, and mutual funds that focus on a blend of mostly equity and a little bit of bonds. And then we can see intermediate term bond funds would be next. So intermediate term means short term bonds are, we would lend a company money for less than a year or two. Long term bond funds, we would lend a company money for 25 to 30 years. Intermediate term is 5 to 15 years. Target date, we talked about those. And you can see the laundry list of things that we can invest in. And we can see both the amounts as well as the different colors here. So in the green are active strategies. So these are strategies where we would pay somebody or our customers would pay us to manage their money and do it actively on a day-to-day basis, paying attention to what's going on in the economy, paying attention to what's happening for each thing that they're invested in, and buying and selling according to whether they think that investment is going to go up or down. In the blue, we don't pay attention. We just ride the roller coaster, the day-to-day roller coaster. And if the stock market goes up, we benefit. If the stock market goes down, we lose. But our goal for passive investments is to just match whatever happens in the overall market. And then, of course, we see here in the gray tends to be global emerging markets or specialty funds. And then in the yellow are solutions. And solutions are things that are constructed for a specific goal. So instead of investing in a specific type of security, in other words, say I woke up this morning and said, well, I'm bullish on stocks, so I want to invest in some stock mutual funds. That's a security that I'm buying. Compare that with a solution strategy where I wake up this morning and I say, wow, I've got a 10-year-old that's going to go to college in 8 years. And so I need to invest something that has a goal of helping me save for that 8-year horizon and takes specific risk return, that specific risk return matrix in mind. And then the mutual fund manager will divide up that investment as she or he sees fit to match that investment goal. Those are solutions. If we think about the different buy-side firms and money managers that are out there, let's go back to those for just a second. So scroll back up. So these are money managers, and this is in millions of euros, okay? So these are very, very large money management companies that companies get larger and smaller by folks investing in them and also by what they're invested in. And so we can see that the level of profitability can be driven by the size of these companies' assets under management. So the most profitable money managers are either boutique managers that have under 250 billion, and their margin, this is EBITDA, earnings before interest and taxes, depreciation, amortization. Think about it as operating profit on a percentage basis. So for every $100 of revenue, you keep $44 of operating profit. And then from that, you pay overhead, back office, and financing costs, taxes, things like that. Small boutique asset managers and very large asset managers have the highest level of profitability, and the lowest profitability are firms that are in the middle that manage between 250 billion and 750 billion. So what that means is that you either need to specialize and be a boutique firm, or you need to be very large. So what's been happening in the past few years is that there's been consolidation in this industry. So there have been a number of deals, some very large deals. These are very large deals. And we can see that the growth rate in mergers and acquisitions has been relatively consistent over the past few years, growing at about 6% per year. And if we look at a recent study by Deloitte, Deloitte looked at all the deals. So on the left-hand side is the deal size. So that's the green bars. So you can see that 2017, very, very large average deal size. And on the right-hand side is the number of deals. So there have been a fair number of deals in the last 2 or 3 years. So that's what we're going to get when we see profitability bifurcated by company size. And remember, way back when, earlier in this deck, we saw, who are the customers of these buy-side and money management firms, pension companies, insurance companies. Those are key clients and key customers. But the two other areas that are growing are high net worth individuals, HNWI, high net worth individuals, and everybody else. So this chart, this comes from Ernst & Young, is a chart of the investable assets. In other words, take the high net worth individuals in the top, quote unquote, 20 countries in trillions US, and what are their net investable assets? In other words, after they pay for their day-to-day expenses, what do they have left over to invest in us? And this is the absolute growth rates, either recently or expected to 2021. So the largest remains in the US, but I also want us to focus on the spread, and the spread has gotten more broad. This was much more concentrated in the US in the past 20 years, and in the next 20 years, Latin America, India, Middle East, China, Russia, Australia, and some parts overall of Europe. And so those absolute growth rates might look fairly small, but remember, this is trillions. So 0.5 is 500 billion US. And that's money that has to get managed, and folks who will want that to be managed quite carefully. And then finally, KPMG did a survey of 85 CEOs in the investment management, asset management / wealth management industry. And what we can see going forward is, one, this industry is getting disrupted. It's getting disrupted for two reasons. One is there's significant global growth, and also folks are concentrating on alternative investment strategies, how technology can help, and cost savings. So we can see that spread out in this CEO survey finding. Progress on technology, but concerns about whether or not they're implementing it the right way. Cyber risk and fraud. Business growth is going to be strong. Not sure if we're investing the right way for it. There's a disconnect between innovation and ambition. In other words, there's emerging technologies, but not sure if we're investing in those quite the right way. There is going to be a renewed focus on the customer. This seems like a trite, easy thing to say, but in the past, let's think about this. Passive investments do not necessarily focus on the customer. Passive investments just seek to mimic what's happening in the market. Well, how does that match to what my specific needs are? So we can use things like artificial intelligence to match what my needs are with a low cost investment strategy. Planning for uncertainty. We don't know what's going to happen, but we can plan for the unknown. And then what types of risks are going to bubble up to the top? And the types of risks that CEOs are thinking about are getting new products to market, marketing and branding, culture, and vision. So that gives us an overview of the wealth management and investment management industry.